as price rallied, it was driven higher by hot speculator, hedge fund, family office, institutional money wanting to buy gold futures. That's what you got to have. And open interest expanded while price went up 7%. Open interest expanded by 30% from about 410,000 to about 530,000. So all of that new speculator buying is what drove price $120 higher or $140 higher, or whatever it was at the end of the day. It will be that continued speculator buying that will continue to drive open interest higher, that will drive price to 2,300 when we get there.
In recent years, the yellow metal has demonstrated resilience in the face of global economic challenges, including inflationary pressures and currency fluctuations. In this video, the founder of TF Metals Report, CraigHemke, observes a 30% surge in open interest, coinciding with a 7% rise in prices, and anticipates additional price hikes propelled by ongoing speculator investments. On Wednesday, February 28th, total open interest stood at 411,698 contracts and near a 5-year low. As of Friday, March 8th, with a price of $145 higher, total COMEX gold open interest had grown by 122,430 contracts to a total of 534,199. That's nearly 30%. This surge resulted from a technical breakout driven by positive gold market news, prompting a substantial influx of speculative capital into COMEX gold futures. Embarking on a unique perspective, Craig positively sees the recent gold price surge, crediting it to bullish remarks from a Fed official and a weaker US dollar. Meanwhile, he anticipates further momentum in gold prices, which aligns with his target of around $2,300 per ounce. Gold peaked significantly in December 2023 and subsequently developed two discernible peaks near the 61.8% Fibonacci retracement level. Presently, there are indications of a potential formation of a third peak. While the current rally propelled gold well above its initial highs, it remains below its peak in December. Despite the recent surge, CraigHemke advises caution on gold due to its volatility and cyclical trends. Looking ahead, he expresses confidence in gold's outlook, suggesting it still has room to climb higher. Now we present the clips of CraigHemke's insights from his recent interview with Liberty and Finance. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
Well, it's a very good sign, for gold at least. Silver's got work to do still to get itself in the same technical position, if you will, as gold. But I'm trying to remember, Elijah, that last time we spoke was probably back in maybe January, right after I wrote this year's annual forecast. And this year's annual forecast kind of echoed last year's, where I said, we're kind of waiting on gold to finally break out. It's been a very well-defined trading range between about 1,700 and 2,000. Maybe you could expand it $50 each way. But it was really in this box going sideways. It's painful to go through that, but it's also beneficial because once you finally break out from a trading range, the longer it goes on, the more obvious that you have a breakout. And that's what finally happened right at the end of February. Three things combined to send, gold, almost 10% higher, 7% higher maybe in about 7 days. You had that breakout. The breakout was driven by what were perceived to be pretty bullish comments by one of the Fed goons, Goon Waller. And he put out a speech that said, I'd like to see the Fed do a couple of things, move most of their balance sheet into the short end. That'll drive down lower short rates, which then usually that means once you uninvert the yield curve, that's when the recession begins. And then he also said that gives us some room on the long end to do more asset purchases when we need to. Hey, that's more QE. So back on Friday the 1st of March, gold shot higher, broke out above the trading range, closed that day at all-time daily highs and weekly highs. You get that breakout, you get this surge of momentum buying. That's what we saw last week. Coincident to all this, the dollar was falling by about 1.5 points, and it became this perfect storm of a breakout. And we got all the way to, I think, 2202 last Friday. So gold is looking stronger, probably still has a ways to go, but that's what has driven gold higher, and it's nice to see it finally happen. And we'll we'll see how this year plays out with the Fed and monetary policy. And I mean, the election is looming out there. All the geopolitics are looming out there. Resumption of the banking crisis could be coming. The banks or the Fed opened up that near-term funding facility last March and then just closed it this past Monday. Commercial real estate, all these different things are out there that, who knows how this will all play out. But typically, anything that makes a new all-time high generates a lot of momentum, a lot of press, a lot of people, hey, I want to jump on board, and you kind of overshoot that all-time high 8-10% higher. And that's why I always thought a move about 2,100 probably send us to 23. And so that's been my target. The move has come exactly as you would expect. Back at the end of February, total open interest, the total amount of contracts for gold on the COMEX was at 5-year lows. Basically, nobody cared, right? I mean, there was no open interest. There was not much volume, not much going on. As price rallied, it was driven higher by hot speculator, hedge fund, family office, institutional money wanting to buy gold futures. That's what you got to have. And open interest expanded while price went up 7%. Open interest expanded by 30% from about 410,000 to about 530,000. So all of that new speculator buying is what drove price $120 higher or $140 higher, or whatever it was at the end of the day. It will be that continued speculator buying that will continue to drive open interest higher, that will drive price to 2,300 when we get there. But again, with all bull markets in COMEX gold, it's never a straight line up. I mean, after that high, I'm back on March the 1st, man, I was sitting there reading my Twitter that weekend, all these people talking about, okay, now gold's going to 3,000. Okay, eventually, but it's not going there by June. That's not how it works. You kind of goes up in fits and starts, 2 steps forward, 1 step back, as these specs rush in, momentum dies out, price goes back down, the specs go back out, and then they get flushed back out. So I'm in the camp of being bullish, but I'm not in this to the moon camp, at least not right now.
Entering 2024, the silver price struggled to maintain its gains due to anticipated slowing industrial demand. Additionally, stronger than expected U.S. inflation in January cast doubt on the prospect of an early interest rate cut by the Fed. Craig actually explains that gold experiences a surge in demand, leading to a breakout, while silver has yet to follow suit. According to him, since new money entered the gold market, silver's rally was driven mainly by speculators covering short positions. So, unlike gold, where price and OI surged together, COMEX silver had a price rally while total contract open interest fell by 2.8%. Furthermore, Craig's analysis suggests that mining shares will grow substantially once silver's market gains momentum by surpassing crucial price levels. Let's get back to the interview.
Think of silver in contrast to gold. I wrote a column about this earlier this week. There's 2 ways you can get rising price. You can get what we've seen in gold, a rush of demand on the long side, right? More buyers than sellers, price goes up. Or you can get a short squeeze. And what's a short squeeze? That's where, a whole bunch of people are short and they're getting squeezed as price is going higher and they're buying back their short. And again, that's buying too. So there's 2 ways of buying that can drive price higher. Gold has seen this rush of new money come in on the breakout. Silver hasn't broken out yet. And so where gold's open interest has gone up by 30% on a 7% rally, silver's open interest has gone down on an 8% rally, at least through earlier this week. And again, that's speculator short covering driving that rally. So what we'll wait for is, just like gold had to break out above 2,100 to have this breakout that everyone can see, silver's still in a box. It's been roughly between 22 and 28 for the last 3.5 years. So gold breaks out, gets a rush of new money. Silver hasn't broken out yet. In fact, before it gets to 28, it's got to get through 26. So for now, silver is just kind of fiddling around, incrementally moving higher, moved higher earlier this week because copper was breaking above $4. Once silver gets above 26 and then makes a move and gets above 28, that's when you'll see a similar move to what we saw in gold this week. Rush of speculator. Oh, look at the clear breakout. But until that happens, it probably kind of continues to poke along. Higher gold will help drag silver higher, but it's not ready to just like blast forward until it gets a breakout like gold is seeing. Mining shares will really get going again when silver gets going. In the meantime, yeah, it's nice to have them off their lows. The risk reward ratio for investing from here is probably pretty good. But, this idea of, all this money flowing into the majors and the juniors and the exploration companies, that's probably not going to happen until silver breaks out. And again, silver is not going to break out until it gets above 28, 29. So there's still time. I guess in the end, the short answer is there's still time. If you believe that gold's breaking out, the debt cycle is terminal, that the Fed is going to have to eventually cut rates and do more QE to keep the plate spinning, and that silver is eventually going to follow, well, then you got all kinds of time still to accumulate a position in some high quality mining shares and silver too.
The yellow metal is forecast to climb about 6% in the next 12 months to $2,175 a troy ounce. Nicholas Snowden, head of metals and commodities research and analyst Lavinia Forsalis, writes in the team's report. They point out gold prices may trade in a range in the near term amid uncertainty about Federal Reserve interest rate policy. What's your take on how the ups and downs in the world economy and government money moves will affect the prices of gold and silver down the road? Drop your thoughts in the comments section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.